Okay, guys, welcome to week 10 of investment analysis. Today's topic is on investment strategies and performance evaluation. And this is the chapter 18 content of your textbook. First, let's dive into the broad categories of portfolio management methods. So there are active portfolio management and passive portfolio management. For the passive portfolio management, the basic philosophy behind it is that the market is efficient, and therefore it would be extremely hard to beat the market, to outperform the market. So the best that portfolio managers can do is actually just to replicate the market, or in other words, passively follow the market. So the best they can achieve is just the market returns or the average returns. And on the other hand, for the active portfolios, the portfolio managers aim for better than average returns. So the aim is to achieve higher than the market returns, unlike the passive methods. And therefore, the active portfolio managers are always looking for superior asset classes, and they are always looking for superior security classes as well. And as a result of the difference in the investment philosophies of the active portfolios and the passive portfolios, their portfolio compositions differ as well. So for the composition of the active portfolio, because we are always like for active portfolio managers, they are always looking for the outstanding asset classes, the outstanding individual securities, right? And we know that the amount of those outstanding assets and the amount of those outstanding securities are actually limited. And this would result in the portfolio composition become really concentrated. And if we, like more specifically, if we are talking about equity portfolios, such active equity portfolios usually contains approximately 30 stocks. And for the composition of passive portfolios, it's usually very diversified. Why is that so? That's because we are replicating the market, right? And we know that in the market, we have a tremendous amount of securities. So therefore, in our passive portfolios that replicates the market, we should have large amount of securities as well. So in other words, we tend to have highly diversified portfolios for passive, like for passively managed funds. And if we are talking about passive equity portfolios, then such passive equity portfolios tend to contain more than 200 stocks. And of course, the exact number would vary depending on the index considered. And what about the transaction costs of those two methods? So for the active portfolios, it tend to have high transaction costs because we are as a portfolio managers, we would be always looking for the trading opportunities, right? Because we always want to look for the superior asset classes at the moment and the superior securities at the moment. So we have to do lots of transactions, and this will lead to high transaction costs, and as a result, high investor fees. And the investor fees are approximately 0.8% to 1.2%. As for the transaction costs of passive portfolios, because we just passively follow the market, This means our transaction cost is little, and as a consequence, the investor fees are low, which is around 0.1% to 0.3%. After discussing those two broad methods, now let's discuss how do we measure the performance of those portfolios. So we start with this specific method here, the universe comparison. So how do we achieve this method? We could simply pick a set of peer money managers with similar investment styles to address their relative performance. This means that we first form a universe and then we do rankings within the universe. So how do we form the universe? For example, we can actually group the high yield bond portfolios into a comparison universe, and we can also group the growth stock portfolios into a universe as well, and we can group the illiquid stock portfolios into another universe, etc. And on the right hand side, we have a graphic example of the universe comparison method. Here we have data on this fictitious group named the Markoville group, and this figure represents the percentile location of this investment firm's funds within the comparison universe. Those black dots represents the percentile locations in the universe, and also we have 4 bars, right? The first bar represents the location of the first bar represents the 1/4 returns of this fictitious group, and also the returns of the comparison universe. The second bar represents the 1-year returns of this fictitious investment group and the returns on the corresponding universe. And the third bar and the fourth bar separately representing the 3 years returns and 5 years returns. Now, after discussing the basic definition and the graphical example of the comparison universe method, now let's look into the drawbacks with this approach. So what are the drawbacks? One drawback is that the peer style benchmark might not be investable. What do we mean by that? This means that even if we identify a group of peer money managers with similar investment styles, it may not be possible to directly invest into a portfolio that replicates their combined strategies. So this should be because that we cannot exactly quantify a combination of those peer money managers strategies. Like, how do we form such a combination? What weight should we assign to each of the money managers? It's hard to determine that, right? It's actually impossible to determine the weight that's to be assigned to each of the money managers. And as a result of that, it is difficult to create an appropriate benchmark against which to evaluate the performance. And aside from this first drawback, the other drawback of this approach is that it ignores the risk difference in strategies of money managers. In other words, similar investment styles do not mean similar risk profiles. Within a particular universe, some managers may concentrate on particular subgroups. For example, within the equity universe, a money manager can concentrate on high beta or aggressive growth stocks, and such concentration on the subgroups can be a reason contributing to the difference in the risk profiles of the strategies of those managers. And if we do not really have the comparable risk levels between managers, then then those rankings are meaningless. So as a result, majorly of this drawback, the universe comparison method is a good starting point, but it can be misleading. Now, so because as we just discussed, because the previous approach can be misleading, now let's take a look at more refined measures. Those more refined performance measures are all risk adjusted, so they explicitly adjust for the risk level. So we have Sharpe ratio, trainer ratio, information ratio, and Jensen's alpha. And we will be discussing more in details of those measures in later slides. Right now, I just want you guys to bear in mind that the purpose of performance evaluation is to ascertain whether the returns earned are worth the risk taken and the management fees charged. First, let's talk about Sharpe ratio. So before we talk about the Sharpe ratio, let's define excess return first. Excess return usually refers to the difference between the portfolio return and the risky-free rate, or the difference between the portfolio return and the market portfolio return. So as we can see from this expression here, the Sharpe ratio is just calculated as the portfolio return subtracting risky-free rate and then divided by the standard deviation. So as we previously discussed in previous lectures and previous tutorials, we know that the standard deviation measures the total risk, right? So the Sharpe ratio is the excess return per unit of total risk. And because Sharpe ratio is associated with the total risk, which is composed of both the systematic risk and the unsystematic risk as well. So the Sharpe ratio is more appropriate when the investor holdings are not well diversified, so that there actually exists both the systematic risk and the non-systematic risk. And such scenarios where the investors' holdings are not well diversified include, for example, when the investor holds only one risky asset. And the other scenario can be that the portfolio represents the entire investment fund of either this investment firm or the individual. And of course, the higher the Sharpe ratio, the better. Now onto trainer ratio. So trainer ratio is calculated as the it's calculated as a portfolio return subtracting the risky-free rate and then divided by the Kaplan beta. The trainer ratio serves just the excess return per unit of systematic risk. Remember, as we said, beta is a representation of the systematic risk. So because of this expression here, because the trainer ratio is accounting for the systematic risk, so the trainer ratio is essentially more appropriate when the investors' holdings are well diversified, so that there is only systematic risk left, and it would be the only risk that is needed to be compensated. And when would we have the investor holdings being diversified? There are two examples. One example is that when the investor is evaluating a stock, which is one of the many stocks he or she held. And the other scenario, the other example is that the portfolio represents one sub-portfolio of many. So in either way, the investors' holdings are well diversified. So that's Treynor ratio. Again, let me emphasize that for Sharpe ratio, it's associated with total risk. So it's more suitable for the scenario when the investors' holdings are not well diversified. And because Treynor ratio considers about systematic risk, so it's more suitable for actually the well diversified portfolios. Or well diversified investor holdings. Now on to information ratio. Actually, let's discuss the Jensen's alpha first and then go back to information ratio, because actually information ratio is defined on the basis of Jensen's alpha. So Jensen's alpha is just about the return, the part of return that cannot be expanded by the CAPM model. So it's calculated as the average return on the portfolio, like the difference between the average return on the portfolio and the return that is predicted by the CAPM model. The following expression is the mathematical expression of Jensen's alpha. So as we can see, alpha is just equal to the return on the portfolio minus, so the actual return on the portfolio minus the CAPM predicted return. And if we recall from previous content, so if we recall about the content from lecture 2, we know that this thing here inside the bracket, it's not only the CAPM predicted return, it's also the security market line. So in short, we call it SML. And as we discussed previously, whenever we have a security that is located above the security market line, we would be having undervalued security. And for any security that's located below the security market line, we call it as overvalued security. And here, the above part is corresponding to positive alphas, and the red part, the part below the security market line, is corresponding to negative alphas. Now let's discuss information ratio. Information ratio is calculated as the ratio is calculated as the Jensen's alpha, so which is alpha PE divided by the tracking error sigma AP, and the tracking error, it is a measure for the non-systematic risk, and it is actually just the standard deviation of the Jensen's alpha. So it's the standard deviation of Jensen's alpha. And because the expression of information ratio is Jensen's alpha divided by the non-systematic risk, right? So as a result of that, the information ratio will be more appropriate if the investor holds a stock that is mixed with a market index fund. So it basically in this scenario here, the investor is introducing extra unsystematic risk by like introducing this stock to otherwise well diversified, unsystematic risk-free market index fund. So basically, like in this scenario, the extra risk introduced is the unsystematic risk. That's why we are punishing the unsystematic risk by dividing by it. And the other scenario that the information ratio is appropriate is that when the portfolio represents an active portfolio to be optimally mixed with the passive portfolio. Again, in this scenario, the passive portfolio only contains the systematic risk, and if we additionally introduce an active portfolio, the risk that we are introducing should be it is actually the non-systematic risk, the unsystematic risk. Yeah, that's the information ratio, and it is a measure of abnormal return per unit of risk that in principle could be diversified away by holding a market index portfolio. And of course, the higher the information ratio, the better. Yeah, and we have already discussed about Jensen's alpha. Now let's move on to the problems of those performance measures. There are several problems. So the first problem is that those performance measures assume that the fund maintains constant level of risks. So it's particularly problematic for those funds engaging in active asset allocation, because like for those type of funds, the level of risk is less likely to be constant. So the assumption is less likely to be true for those active funds, so for those funds that engage in active asset allocation. And another issue aside from the assumption of constant level of risk is about survivorship bias. So the calculation of those performance measures are usually associated with survivorship bias, because when we are calculating those measures, we usually only look at the data on the existing portfolios. But by doing so, we are ignoring those losers. So, and those losers, those funds, those portfolios that loses and even go back, like because of they lose too much, they actually go bankrupt and they do not exist. And because we are ignoring them, this means that our calculated average fund performance would tend to have upward bias because we are ignoring those losers. So that's survivorship bias. That's the second issue with those performance measures. And we might also have actually we might also have another issue. Another issue is that those performance measures in reality can be calculated as negative, and the negative measures are meaningless and useless. So why would we encounter negative performance measures in reality? The reason is that nowadays the market is becoming increasingly efficient, and this basically pushes those portfolio returns to become like close to the market returns because of this increased efficiency. And aside from this efficiency, we also have that the portfolio managers have to pay high research costs and also high trading costs. And it's those two costs make it even harder to outperform the market. And therefore it's more likely to encounter negative performance measures nowadays. But negative performance results are meaningless. So that's the problems with performance measures. Now, let's talk a little bit about market timing. So, on the later slides, we will be discussing about how do we decompose the performance that we just evaluated. So, like in the previous slides, we are evaluating those portfolio performance rate, and after like calculating those performance measures, we actually want to decompose the performance measures further into various components of the portfolio building process. So we want to attribute those performance measures into different components, into different strategy, like attribute those performance into different strategies. So let's look at market timing right now. So market timing is one of the components of the portfolio building process. And of course, the market timing can contribute to the portfolio performance. And what is the definition for market timing? The market timing ability, it is the ability to adjust asset allocation for changes in the market. So let's we actually might be able to calculate the value of market timing. Let's define the perfect market timing as the ability to tell at the beginning of each year whether the S&P 500 portfolio will outperform the strategy of rolling over 1 month T-bills throughout the year. So this is just an example that we will be using to try to estimate the value of perfect market timing ability. So again, let me repeat myself. So our assumption here is that we define the perfect market timing as the ability to tell with certainty at the beginning of every year whether the S&P 500 portfolio, the market index portfolio, would outperform the strategy of rolling over 1 month T-bills throughout the year. So the T-bills. So actually the per year payoff of the manager with a perfect timing ability is exactly the same as the per year payoff of the combination of the bill and a call option. I will explain a little bit more about this in this table, and because we said that the payoff of the combination of the bill and the timing ability is exactly the same as the payoff of the combination of the bill and the call. So this means that the perfect market timing ability is like a call option, and we can try to estimate the value of the market timing ability by calculating the value of the corresponding call option. So in this example here, where this portfolio manager has a perfect ability to forecast, if we look at the payoff of this manager who can do perfect forecasting, then we know that each year, if the market index value like at the end of year, which is denoted as ST, is smaller than S0 times 1 plus RF, which we also denote as X. If ST is smaller than X, then actually the manager with perfect foresight will choose to like stick with the risky-free asset, because the risky-free asset will pay more than the market index portfolio, and the payoff earned by the manager would be the payoff on the risky-free asset, which is S0 times 1 plus RF. And if we have ST is greater than or equal to X, then the manager will choose to stay with the market index portfolio. So he would not like the first scenario where he sells the market index portfolio and then transform it into the risky-free asset. In the second scenario where ST is greater than or equal to X, ST is greater than or equal to X, now it's profitable to hold the market index portfolio. So in this case, his payoff at the end of each year would be ST, and ST is just the value of the market index portfolio at the end of each year. That's a payoffs. That's a payoffs of the manager with perfect market timing ability. If now let's take a look at the combination of BIOS and call options. So let's assume that for the call option we use, it's the call option with the exercise price being equal to X, and also it has the starting date being the start of each year, and the maturity date, the exercise date, being the end of each year. So in that case, we will be able to derive the payoffs of the BIOS and the payoffs of the call options separately. So for call options, the payoffs when ST is smaller than X should be 0, because it's not profitable to execute in this scenario. And if ST is greater than or equal to X, then it's profitable to execute to exercise the call option. So the call option holder will exercise the option and then buys the market index at the exercise price of X, and then sell this market index at the current value of the market index, at the end of the year value of the market index, which is ST, and the third, his payoff would be just ST minus X, and that's a payoffs of the call options under these two scenarios. And we know that like for either of those two scenarios, the payoffs of BIOS would just be S0 times 1 plus RF. So if we sum the payoffs of BIOS and call for both of these two scenarios, we will find out that the total payoffs, like from the sum of the payoffs of bills and calls, under these two scenarios would be exactly the same as a total payoff of the manager with a perfect market timing ability. So like the total payoff of the combination of bills and call when ST is smaller than X would be S0 times 1 plus RF. And the summation of the payoffs of bills and the call options when ST is greater than or equal to X is just S0 times 1 plus RF plus ST minus X. And this leads to actually just ST. So that's just an explanation of how we can try to evaluate the market timing ability, the market timing performance by looking at a call option, like by trying to evaluate it as a call option. But in reality, there is little evidence of persistent market timing ability. And here, the example we just discussed is actually associated with perfect ability to forecast. So how do we deal with the scenarios with imperfect ability to forecast? How do we estimate the market timing performance in such scenarios with such assumptions? What we can do is that we can resort to to estimate the value of the market timing ability if we have imperfect ability to forecast. So under this scenario, what we can do is that, of course, again, we are faced with a call option, but right now, it's not only a function of the value of the call option, but it's also it's not only the value of the call option, it's actually a function of the value of the call option and also the proportions of correct judgment on the bull markets and the correct judgment on bear markets. So it's just so here for the second point, I'm just trying to say that if we want to measure the market forecasting, if we want to measure the market timing performance with imperfect ability to forecast, we have to also look at the proportion of bull markets correctly forecast and also the proportion of bear markets correct forecast. Yeah, that's market timing. Now let's take a look at the performance attribution procedures. So here, it's a method that decomposes the portfolio performance into different components of the portfolio building process. More specifically, this particular method here, only focuses on asset allocation and security selection. Of course, the timing can also contribute to superior or inferior performance as well. But here for this particular method, this performance attribution procedure method, we only focus on the first two. And for this method, we usually start with a difference in the performance between the manager portfolio and the benchmark portfolio. And we also have another name for the benchmark portfolio. We call it as bogey. Benchmark portfolio is usually is usually the unmanaged passive index portfolio. And we, like, when we are implementing such method, we try to explain the difference in the performance of those two portfolios by examining the quality of the asset allocation decisions and the security selection decisions. Now let's take a look at the calculation example. So how do we attribute the difference between those two portfolios into asset allocation and security selection? First we just calculate the difference between those two portfolios. So for the bogey, we know that the benchmark weight of each component 0.6, 0.3, and 0.1 separately. And 0.6 is corresponding to equity market, 0.3 is corresponding to bond index, and 0.1 is corresponding to money market. So the return on the bogey is calculated as 0.6 times the index return 5.81 and plus 0.3 times the bond index return of 1.45, and then plus 0.1 times the money market return of 0.48. And this means that the return on the bogey is 3.97. And if we use the return of the managed portfolio, subtract the return of the bogey portfolio, we obtain that 5.34% minus 3.97%, which leads to 1.37%. Now let's do the performance attribution. This example is also on the textbook. You can refer to table 18.7 on your textbook. So here, we contribute this this difference in the performance into the asset allocation decisions and the security selection decisions. So what is the contribution of the asset allocation decisions? Actually, the asset allocation effect refers to the ability of assigning an appropriate weight to different markets. So to calculate the contribution of asset allocation, what we do is that we focus on the excess weights because we focus on the correct weights, right? So we focus on the excess weights. So we first calculate the difference for each market, between the weight in the portfolio and the weight in the benchmark. So for equity market, we use the weight. We actually use the weight in the portfolio, which is 0.7, minus the weight in the benchmark 0.6. This leads to the excess weight of the equity market, which is 0.1. And we do the same for the fixed income market and the cash market. So for fixed income market, we use the actual weight or the weight in the portfolio, which is 0.07, minus the weight of fixed income in the benchmark, which is 0.3. This leads to the excess weight of the fixed income market being minus 0.23. And we do the same for the cash market to obtain the excess weight of the cash market. And with those excess weight of each market segment, we just use those excess weight times the corresponding index returns, and then we just sum those three products. So if we look back at the bogey, we look back at the benchmark, we know that the index returns are like in this column here. So we just use the data in this column and times the excess weight. This leads to these three terms, these three products. And if we sum those three terms, we will be able to calculate the contribution of asset allocation to the performance. And now let's move on to the contribution of security selection to total performance. So the selection effect refers to the ability of conducting industry sector selection, and most importantly, the security selection within each market segment. And by market segment, I'm referring to, for example, equity market, fixed income market, stuff like that. So because we are focusing on selecting the return, we are focusing on selecting the securities that are delivering the superior returns, right? So we are focusing on selecting the securities that are delivering superior performance. So to calculate the contribution of selection, we would be focusing on the excess performance of each market segment. How do we calculate the excess performance of each market segment? We just use the portfolio performance minus the benchmark performance, like the benchmark index performance. So for equity market, we know that the portfolio performance is 7.28. And as we showed previously, again, like for the, in the second column here in the previous slides, again, we showed that the performance of those index returns. So to obtain those excess performance, what we do is just that we use a portfolio performance of each market segment minus the index performance that we just discussed in the bogey, in the benchmark. So yeah, here the second column, again the second column, and just by doing this subtraction for each of the market segment, we would be obtaining the excess performance of each market segment. And what we do next is that we use the excess performance times the actual weight, the portfolio weight of each of the market segment. And we know that we already showed here the weight of each market segment in our portfolio, which is 0.7 and 0.07, like respectively for the equity market segment and for the fixed income market segment. We use the excess performance times the portfolio weight for both the equity market segment and the fixed income market segment. And then we would be obtaining 1.03% and 0.003% respectively. And if we add them together, that would be the contribution of selection. Again, like for the calculation here, what I want to emphasize is that for the contribution of asset allocation, because we are focusing on assigning the correct weight, the appropriate weight to different markets. So we actually focusing on calculating the excess weight and then calculate the contribution to the performance on the basis of the excess weight. And when we are calculating the contribution of security selection to total performance, because we are focusing on the ability of choosing the securities that deliver a superior performance, deliver superior returns. So for this part, for this component, we actually focus on excess performance. So which is just a difference between the portfolio performance and index performance of each market segment. And we just and we just calculate the contribution of selection to total performance on the basis of this column of excess performance we calculated. And that's all of the content of today's lecture. Thank you guys for attending this lecture.